Hello and welcome to Money Pathshala. Joining me today is one of India's best-known financial planners, Surya Bhatia, and we are going to talk about target maturity funds. Everyone has been speaking about them. You've read and heard opinions on social media and in the media around target maturity funds. And we thought we will decode for you what are target maturity funds and should you invest in them. Surya, thank you very much for coming here on Money Pathshala. And my first question to you is, while there's a lot of talk around target maturity funds, but, it's important to actually first explain to viewers and people what are these target maturity funds, because we do have a plethora of debt funds. So if you could put it in context of the existing debt funds, how are these different? And what is a target maturity fund?
I think, Vivek, this is a new concept which has come out over the last year or two. These kind of structures, if I use that word, were not available in the markets, in the open debt space. As the name says, target maturity. What it simply means is that any investment you do in a debt category, it's a pure debt fund, by the way, in the debt category, will run its life till maturity. Hence the name target maturity, which also means the fact that they will end up buying the papers which will have a roll down impact. To give you an example, they will buy you a paper, or let's say a 5-year maturity, and will hold till the end of the 5th year. So you know that if you are entering at the start, when the fund opens up, till the maturity of that 5-year, you know that for sure, what is my approximate yield to maturity on that fund. So the returns, more or less, you can say, are assured if you are able to hold the paper till maturity. So what it means is you need to invest in the security in this category only if your time horizon matches with the duration of this fund. Because if you redeem the money before that, and this structure is an open-ended structure, allows you to invest or redeem whenever you wish to. In that case, the returns may not carry that coupon which you invested at the time of investment. So that assurance is only available only if you hold the paper till maturity, because they are also doing the same thing on your behalf. So therefore, it's a passive strategy that they buy a particular paper with a particular coupon and then hold till maturity. And target maturity funds typically invest only in 3 categories within the debt space: government security, SDLs, state development securities, and PSU bonds, which means the credit quality is also very high. Government securities, a sovereign debt; SDLs, because the interest and the principal payment happens from the state government coffers, hence can be also a semi-sovereign category. And PSU also comes from the ownership of the government, hence also carries a high degree of safety tag. So hence, these 3 combinations are available in a target maturity, and hence is good for investors who want to have a low credit risk portfolio, but are able to match the horizon with the duration of the paper.
Surya, when you say assurance, what does that mean? Because mutual funds, under various regulations of SEBI are not allowed to guarantee, any returns post the UTI debacle. I mean, for the last 20, 25 years, they're not even allowed to use the word guarantee. So when we say assurance, yes, I mean, if you locked yourself in, as in the fund house has locked itself in and has stayed till maturity, it is, and as you mentioned, these are all government or sovereign, quasi-sovereign.
State government, quasi-sovereign governments, yeah.
But is there, any scope for an investor not to get the return that was mentioned at the time of entry?
See, it's not easy to answer because you are entering into a sovereign debt. So there, the probability is as good as zero. But if you come to the PSU, again, the probability is low. You cannot call it zero. And in a quasi sovereign debt, the state government has to pay the principal and the interest. So again, the probability is on the lower side. But can you call it zero? The answer is no. It is up to the investor to decide how much risk is being carried in these securities and then take a call. However, on the safety aspect, it comes on the high category. But yes, you cannot say that this instrument is guaranteed, because the word guaranteed is not allowed to be used by the mutual fund houses. But so is the case with a bank deposit also. Or so is the case with a company deposit also. You just go basis the rating of that instrument. If you do a company deposit, you go for a AAA or a likewise product. Similarly, you assume that a bank FD will not default. But there again, we have seen instances where we have seen defaults or delays in the payment of your coupons. But I'm not saying the fact that you have to go to this because there could be defaults in other papers. The credit quality is high. Basis that, you have to decide which instrument suits me the more, and accordingly you need to invest.
Surya, you have always spoken of asset allocation, and I am sure that the hundreds of clients that you manage, I'm assuming in almost all those cases there is already a bit of debt in a portfolio. There'll be very few which are 100% equity. Debt instruments have been around for the longest time, and they're already built into many of the portfolios, depending from client to client, that you would have constructed. So, when you look at, say, today, the liquid funds or the existing bond funds, and I'm asking this because of the whole interest rate scenario that is prevailing, and I'm sure that's why these target maturity funds have also become popular, because there is an anticipation that we are coming close to peaking as far as the interest rate cycle is concerned. At the same time, a lot of consumers are rushing to banks because banks are offering 8%, 9% kind of fixed deposits. So if I am an existing investor and who has already got a debt portfolio in a debt component in my portfolio, would you as a planner be asking people to switch from, say, a liquid fund or a bond fund that you've chosen and move them to a target maturity fund? Or would you say that only fresh money, if you have, I would put it in a target maturity fund?
See, there the answers lies specifically for each investor. If any investor is holding any amount of money in a liquid fund or likewise in a short-term debt maturity, is there a particular need for that money to be held in a liquid or the ultra short-term or the short-term? If there is a reason to hold the money in that category of the shorter end of the curve, then it is still advisable to hold in that because you need the money in the short term. As I just mentioned, the target maturities are suitable for investors if the duration matches with your need of the money. So if your need of money is not matching, then definitely this is not a good instrument for you, because you are going to buy a medium term, let's say a 3-year or a 5-year medium to long term bond, which we can categorize in the space of the need of the money, vis-a-vis the need which you have is short term. So therefore, it may not fit your profile. It's a good instrument subject to you can match your duration. And in the income tax perspective, you need to hold for a 3-year to qualify for a long-term capital gain. So therefore, depending on your need of money, you have to pick and choose whether a 3-year with higher tax efficiency is a go forward for me, or do we need to do something because I need the money Hence, tax efficiency may not be that important for me. So that you have to decide basis your allocation of the assets, basis your need which you carry, that which instrument suits your particular profile.
Because what you mentioned earlier is that while they are liquid in the sense you can withdraw your money anytime, however, if you do that, then you run the market risk that you may not get
Absolutely
what was actually...
You have the mark to market.
Yes, yes. So they are liquid.
You have the mark to market risk.
You must not enter if you cannot stay for the duration. Is that what you say?
That's right. To give you an example, today, let's say my repo rate is 6.5%. Come this April, the repo rate may get increased from 650 to 675. Now, if that happens and you have entered today, your NAV will be trading at a discount, which means if you plan to sell in 3 months, hoping to make higher coupon, higher interest, on the contrary, you may sell your instrument at a discount or a loss. But you will get your guaranteed coupon, provided you hold till maturity. That assurance is there. But you need to hold till maturity, not before that.
One final question, Surya, there is always the debate, and I must have asked you this question dozens of times over the years, between fixed deposit, and as I mentioned that there is, and I was reading that, certain smaller banks are even offering up to 9% for FD. And let's face it, not so much the younger generation, but certainly our generation or the one before that is still largely an FD investor. Can you once again explain to viewers that, vis-a-vis doing a fixed deposit with a bank, and on the other hand, so even if I do a fixed deposit, I would do it, say, for 3 years or 5 years. So instead, if I were to take a 3-year or 5-year target maturity fund at this point, how would it be beneficial compared to a fixed deposit?
See, you have to understand that what your tax effectiveness rate is. For every assessee, your marginal rate of tax is critical to know. So if you come into highest tax bracket, then comparative between a target maturity or any debt structure which you plan to hold for long term, and here long term is defined as 3 years from an income tax perspective, as I mentioned, more than 3 years qualifies you for a long-term capital gain. Assuming, let's say, a target maturity today offers me around 7% of coupon on an average, and a bank FD gives me 850, 870, or even 9% in some cases. But if you end up paying a 30% tax, assuming you're the highest marginal rate of tax, on a 9%, you pay 30%, which means what you get in hand is 6%. On a simple math, so I'm not counting surcharge or cess right now in this. And in a target maturity or any open-ended debt structure, if you are entering at a YTM of, let's say, 7%, and you are enter it now, you get the benefit of 4 years of indexation if you hold for 3 years and plus. 3 year, 1 month you hold, you get a 4 years of indexation, which effectively makes your return of 7% as good as tax-free. Even if I have tax incidence of, let's say, 5 or 10%, even then it is able to match or beat your bank fixed deposit vis-a-vis a clear-cut difference of 2% on the coupons. Now, only in the scenario where you are not in a tax bracket or you are in a very low tax bracket, then an absolute return is what really matters to you. Which means if you're earning a 9% coupon or even an 8% coupon and you're not in a tax assessee, then of course 8% is superior to a 7%, even if it becomes tax-free. And hence, then you should opt for that bank deposit, which offers you that 1% or 2% extra return vis-a-vis a target maturity, or likewise any other debt product. So you have to look at from the perspective that what is your need of money. If it's less than 3 years, then by default, they are short-term capital gains. Hence, you can consider whichever gives you a higher coupon. But if your intention is to hold for long-term, again, more than 3 years, then your tax effectiveness will be decided based on your marginal rate of tax.
Always a pleasure talking to Surya. Look forward to having many more such
Thank you.
conversations
Thank you,
here on
Vix.
Money Pathshala.
Always lovely to catch up with you.
Thank you very much, Surya.
Thank you.
Thank you.